Hello, welcome to Business Incorporated. I'm Laddie Williams. Coming up on the show today. IMF warns that intervention funds can hurt emerging markets. And World Bank approves $500 million to support Ethiopia's universal electricity access by 2025. New Nile Dam talks between Ethiopia, Egypt, and Sudan collapse in the DRC. Let's get the show started with intraday market numbers. Here in Africa, markets we track were in a sea of red. South Africa's GSE fell 0.88%, while Nigeria's main index lost 0.26%. Elsewhere in Egypt, the EGX30 declined 0.29%, and Kenya closed Tuesday's session negative. Investor sentiments in the Middle East were mixed at intraday. The Qatari index jumped by almost 1%, while Saudi Arabia's market was 0.11% higher. In the UAE, the Abu Dhabi index shaved off 0.78%, while Dubai's index fell by 0.57%. And European stocks were muted today as investors digest global market moves, particularly a pullback in the U.S. market on Tuesday. Let's bring in Chelsea Delaney now to give us more updates from the European scene. Hello, Chelsea. Great to have you. The IMF has released its latest World Economic Outlook with China and the U.S. Leading recovery from the pandemic. But what is the outlook like for Europe?
Well, Europe is certainly going to be lagging behind the world recovery and particularly the recoveries in the U.S. and China. The IMF expects the European economy to grow by about 4.4% this year. That is a strong recovery, but it's about 2 percentage points below the growth in the U.S. and about half of that of China. And part of this is because the EU is still battling the coronavirus. Many countries remain in lockdown. In some countries, lockdowns are expected to only get tougher in the weeks ahead. The vaccine rollout is moving very slowly here. So all of that is depressing economic activity. Another problem that Europe is facing is that it hasn't done enough to stimulate the economy. So the EU has put forward a 750 billion euro stimulus package that was agreed last summer, but that money still hasn't flown to countries yet. It's been really delayed by bureaucracy within the EU, between political infighting between EU countries. So while China's economy is recovering quite strongly, while the U.S. is putting trillions of dollars worth of stimulus into the economy, here in Europe, it's certainly recovering at a much slower pace.
All right, the European Union said it could meet its target of vaccinating the majority of adults by June instead of September. Vaccine rollouts have been lagging in Europe. Is this realistic?
It's certainly a very optimistic goal from the EU Commission. So far, only about 13% of the European population has received their first coronavirus vaccine. So to get up to their goal of having 70% of the adult population vaccinated, that's quite an acceleration in the pace of the vaccine rollout so far. The EU is expecting things to improve really starting this month. They do expect much higher deliveries of vaccines from both AstraZeneca, but also the BioNTech-Pfizer alliance, and we will start to see some new vaccines coming into play, like the Johnson & Johnson or Moderna in the months ahead as well. So they are expecting a big increase in the available doses, but there's still a lot of outstanding questions here in Europe. For one, a lot of these vaccine manufacturers have fallen behind on commitments, so it's unclear whether they will be able to meet these deadlines. But here in Europe as well, there is a lot of concern over the AstraZeneca vaccine, which has been one of the major players in the vaccine rollout. There have been links between blood clots and that vaccine. So some countries, including Germany, have restricted what populations can receive that vaccine. Today, actually, in a few hours, the European Medicines Authority is expected to rule and give its results on how closely that vaccine is linked to blood clots. So that will play a big role in how the European vaccine rollout progresses from here.
All right, looking at Germany's economy now, public deficit rose to the highest level in 3 decades due to the pandemic. What does this mean for Europe's largest economy, especially with the finance chief saying now is not the time to reopen?
Well, Germany, like the broader EU, is facing several more months, if not at least another year of economic difficulties. The last year, Germany did really increase public spending. They saw tax revenues decrease, but they did put forward quite a bit of stimulus, and they have been supporting the economy through various measures, through things like short-time work schemes, but also various grants, public support to people who've been impacted. So they have done a lot to stimulate the economy. That's why we've seen the deficit rise so much. This is actually the first deficit that Germany has had in 7 years, and it's largest since reunification 3 decades ago. So it was a really tremendous break from tradition for Germany, which has been very strict on keeping a balanced budget, not going into debt. So the question now is really what sort of political will there is to continue spending money in the years ahead. So the government has agreed to continue deficit spending this year. The outlook for further years is a little bit more uncertain. So the EU economy, the German economy, still needs support. The question is whether the government and whether there's enough political cohesion to continue spending to support the economy through this crisis.
All right, Chelsea, thank you for the updates. Enjoy the rest of your day. Now moving to the UK, the IHS market CIPS composite PMI combined reading of services and manufacturing business activity came in at 56.4 for March compared to 49.6 in February. It marked the first expansion, a reading above 50 in 3 months. Let's talk to Juliana now for updates from London. Great to have you, Juliana. UK business activity for March has been downgraded slightly, but the PMI signals a rebound. What are you hearing about this?
Well, it's good news, Laddie, coupled with yesterday's IMF upgrade outlook on the UK economic post-pandemic recovery. This is certainly going to cheer up Chancellor Rishi Sunak, and it basically signals that British business is back to expanding. There are so many reasons why, and I think this one is of particular importance because, as you said, the composite also includes the services industry, which contributes 80% to Britain's economy. That's just how crucial this reading is, and really it is a lot of people putting it down to Prime Minister Boris Johnson's successful vaccination programme, as well as him outlining the rolling back of these pretty tough restrictions that we've been in for the past 4 months. We're expecting on Monday non-essential retail and hospitality to open. That's even going to give it more of a boost. Earlier in the month of March, children went back to school. Parents obviously spending hundreds of pounds on uniform because kids had been sitting in front of their laptops and computers. So this is also very, very great. I think as well, a lot of people have been citing the boom in the housing market, and that's been helping the services sector. We spoke earlier last month about the unemployment data showing that for the first time, it does appear as if the worst case scenario is in fact over. And there are hundreds of thousands of jobs, new jobs now being added to Britain's labour market. So, you know, it's all in good time. We are in the second quarter of the year. So this shows that Britain may finally be getting out of the doldrums.
Yeah, good one there. But Deliveroo shares have opened slightly higher on the first day of unconditional trading. What's driving this, and how is it impacting the entire market?
Well, the FTSE is in positive territory at intraday. Yesterday, we actually saw a dip in some of these takeaway stocks. Just Eat Takeaway, for example, and Deliveroo, of course, were all trading down. And that was because I think there was a fear from investors that when on Monday you start seeing the opening of pubs and restaurants, that there could be a dip in ordering of takeaways, but it appears today as if they've changed their mind, which is why we are seeing Deliveroo shares finally picking up after what has been a pretty disastrous week for them. There's also some conversation, which I did have with Innie earlier this morning, about there being a strike. A lot of workers still not happy with the fact that they don't get any holiday pay or sick pay or anything like that. But the markets are still cheered at intraday. The all share is up 0.32%. The FTSE 100 is up by 0.71%, and the FTSE 250 up by 0.53%. In the currencies market, the British pound down today on the US dollar by 0.01%, down on the euro by 0.15%, and down on the Japanese yen by 0.05%.
The protest at Barclays headquarters. Barclays has issued a statement, and I'm wondering what they're saying at this point, with what happened earlier today.
Got the statement here. A spokesman has said Extinction Rebellion are entitled to their view on capitalism and climate change, but we would ask that in expressing that view, they stop short of behaviour which involves criminal damage to our facilities and puts people's safety at risk. They go on to say that they are trying to reach net zero emissions by 2050, but obviously, as we were saying, this follows this morning's pretty audacious attack, some may call it, by Extinction Rebellion, very popular group known here in the UK for disrupting the goings-on when they want to make an environmental statement. 7 women used hammers to break glass in Barclays headquarters in Canary Wharf, basically saying breaking glass is better than breaking promises. Barclays are the biggest financial backer of net zero, of fossil fueling companies. Between January and September last year, they financially backed $25 billion worth of these investments. And it's not just environmentalists. Shareholders are also not happy. And it just sets the scene, really, for what we can expect at COP26 in Glasgow later this year. Britain is going to be taken centre stage, and they do want some of these dirty companies to start cleaning up their business.
All right, Juliana, thank you so much for the update. We'll keep tracking that story, see how it goes. Thank you so much. And Asia-Pacific markets traded mostly up today, but shares on the Chinese mainland and in Hong Kong lost ground. Australia's ASX 200 advanced 0.61% to 6,928 points, with all sectors closing higher. In Japan, the Nikkei 225 retraced most of its earlier gains, but still closed up 0.12% at 29,730 points. The Topix index rose 0.67% to 1,967 points. South Korea's Kospi added 0.33% to 3,137 points. Hong Kong's Hang Seng Index declined 0.91% to about 28,674 points as the market returned online after being closed since Friday. And China's mainland shares also struggled for gains. The Shanghai Composite finished fractionally lower at 3,479 points, while the Shenzhen component fell 0.74% to 13,979 points. I will bring you more developments across the African continent after the break. Do stay with us. Welcome back. A new round of African Union-mediated talks between Ethiopia, Egypt, and Sudan aimed at resolving a year-long dispute over the Grand Ethiopian Renaissance Dam appeared to have broken down yesterday. The dispute centers on the speed at which a planned reservoir is filled behind the dam, the method of its annual replenishment, and how much water Ethiopia will release downstream if a multi-year drought occurs. Another point of difference is how the three countries would settle any future disputes. The three sides are all seeking to find some common ground, but Egypt's foreign ministry said in a statement that Ethiopia had a lack of political will to negotiate in good faith. And if this dispute is not settled, that will be what will be the implications on economic and investor sentiment for these countries, particularly Ethiopia? Matt Kindiger, an associate lead practice for Sub-Saharan Africa at Frontier Views, joins us now to provide answers to these and more. Hello, Matt. Great to have you.
Hi. Thanks for having me on the program today.
Thank you. So what are the regional implications of the failure of these talks between Ethiopia, Egypt, and Sudan?
So broadly, it's very disappointing that the talks have failed, and it does not bode well for the outlook for regional tensions. At the very least, it means Ethiopia is likely to become a bit more isolated on the international stage, and it also raises questions about what the next move by Egypt and Sudan will be. So certainly a lot of anxiety. However, I don't think this is the end of the story. There are likely to be more talks over the coming months as all sides take stock. And very crucially, in Ethiopia, the country is holding an election on the 5th of June. So in about 2 months' time, we probably won't see much movement on the Ethiopian side until the election. And the government is also being distracted by the crisis in the Tigray region in the north of the country. So a couple of things have to happen before we see some movement on all sides.
All right, looking at the time of completion now, is it likely to be delayed given the regional tensions it's generating at this point?
So the tensions themselves are unlikely to be the primary cause of a delay to the completion of the dam, and this is because Ethiopia is unlikely to unilaterally back down or concede its position, and this is because the dam really is a cornerstone of economic development for the country. It will provide a significant amount of electricity, which is crucial for the country's economic development. And the Ethiopian government has said that it wants to proceed with the next stage of filling of the dam in July. So really, the regional tensions are not the primary reason for a likely delay. There are other things that could cause a further delay to the completion. One is, say, external pressure from the US or China, which may mean that the Ethiopian government finds itself forced to come back to the negotiating table. Or the other is that an increase in violence and unrest in the Tigray region over the course of the year could distract the government even further and drain resources away from the dam. So those are two other reasons that could cause delays to the dam's completion.
All right, how will a delay to the completion of the dam affect Ethiopia's economic outlook and the country's business landscape?
So there'll probably be quite limited short-term implications for the economic outlook and for businesses in Ethiopia. In terms of short-term dynamics, the government's weak fiscal position and the Tigray conflict present bigger risks for the economic landscape, and businesses are a bit more concerned about high inflation and currency volatility. But certainly, in the longer term, say over the next 2 to 5 years, delays to the dam's completion could certainly derail the government's economic development plans. The government is aiming to grow the economy by, very rapidly over the next few years. Electricity generation is part of that development plan, and without the completion of the dam, there certainly is a risk to the country's longer-term economic prospects. So certainly something that could affect the long-term economic outlook.
All right, Matt, thank you so much. We'll keep tracking that story to see if they resolve it. Well, thank you for the update, and do enjoy the rest of your day.
Thanks very much.
Thank you. And the World Bank has approved a $500 million International Development Association credit to support Ethiopia's goal of achieving universal electricity access by 2025. The access to distributed electricity and lighting in Ethiopia project is an important component of Ethiopia's national electrification program, which aims to strategically change direction from infrastructure development to the delivery of adequate, reliable, and affordable electricity services with a vision to reach universal electrification by 2025. The project will focus on access to new and improved electricity services for households, smallholder farmers, commercial and industrial users, and social institutions in urban, peri-urban, rural, and deep rural areas. Over the past decade, the government of Ethiopia has made encouraging progress on its electrification program and expanded the grid network coverage to nearly 60% of towns and villages. But despite this progress, Ethiopia has the third largest energy access deficit in sub-Saharan Africa, with more than half the population still without access to reliable electricity. And International Monetary Fund has warned developing countries that the various intervention funds they got to cushion the effects of the COVID-19 pandemic have consequences. According to the director of the Monetary and Capital Markets Department at the IMF, Tobias Adrian, extraordinary policy measures have eased financial conditions and supported the economies, helping to contain financial stability risk. But those rescue efforts may have unintended consequences and sow the seeds of future financial market instability. He says addressing corporate sector weaknesses and repairing balance sheets is a priority, and advanced economies should tighten selected macroprudential tools to safeguard financial stability while avoiding a broad tightening of financial conditions. He adds that emerging markets should rebuild buffers to prepare for potential repricing of risk and reversal of capital flows. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.